Okay, so today we're really diving deep into, I guess you could say, the bedrock of disciplined investing. We're pulling out the foundational wisdom from Benjamin Graham using his masterpiece,
Okay.
Intelligent Investor, and some of the key commentaries on it.
Exactly. And our mission here isn't just, a book report. It's to really distill those core principles, the ones that separate sound, pretty low maintenance investing from what's often just dangerous speculation. It's about giving you, the learner, a clear framework, not for market thrills, but for long term financial security, rooted in common sense, really.
And Graham's ideas, they've held up remarkably well. He wasn't just an academic either. He started out as a clerk, bond trading firm back in 1914, became an analyst fast, then a partner. Saw firsthand how markets get seduced.
Yeah.
Like that Sable Tire example, 1919, big buzz stock jumps 250% on day one.
Right. A classic speculative bubble, short term mania. And Graham saw how it ended. By October that same year, exposed as fraud, stock worthless, that kind of thing, that boom and bust, even a century ago, it really shaped his view that discipline. Well, it isn't just nice to have, it's essential.
So let's start right there.
Mm.
Graham's definition. What is an investment operation according to him? What separates it from, just gambling?
He's incredibly clear on this. It needs three things, always. First, thorough analysis. You have to understand the company, its business, is it fundamentally sound?
Okay, thorough analysis. Makes sense.
Second, deliberate protection against serious loss. Safety of principle, he called it, guarding your downside. And third, and this trips people up sometimes, you need to aspire to an adequate return. Not extraordinary, not a home run right away. Adequate.
That three-part definition feels solid, even now. But that third point,
Yeah.
adequate returns. Why is aiming for massive quick profits seen as not investing by Graham?
Well, because chasing those huge returns almost always means you're paying a huge price or taking on massive risk for something unproven. Speculation, Graham basically said, it's like a casino, just a unique kind. Wall Street loves the hype, the excitement. Aiming for quick mega profits means you're sacrificing safety, you're sacrificing analysis for just volatility.
Yeah, the source material has that sharp line. People who invest make money for themselves. People who speculate make money for their brokers.
Exactly right. All that churning, all that trading, it generates fees, lots of fees for the middleman. Doesn't necessarily mean reliable profits for the person doing the trading.
And you see this speculative fever pop up again and again because there's always someone saying this time it's different. Like James Cramer during the tech boom saying you got to throw out all of the matrices and formulas and texts that existed before the web.
Throw out the formulas. That's the classic sign, isn't it? The illusion that things have fundamentally changed. The sources point out for decades, people thought you could buy leading stocks at any time and at any price, and you'd eventually be okay.
An illusion that got shattered.
Brutally, yeah. The 1969-70 market dive, and then Penn Central, a giant railroad then going bankrupt in 1970, showed, even huge companies aren't invincible. Price always, always matters.
And it's not just big institutions failing. Graham also nailed the human side, the behavioral failures, like the day trading craze. You had stories like a waiter thinking he'd make $100,000 in a year trading 10 times a day,
Hmm.
or even Barbara Streisand saying she sold fast whenever she saw red in my profit or loss column.
Yes, that panic selling, that gut reaction that just bypasses any kind of rational thought. Fear and greed, they're universal, and they lead right into the psychological battle every intelligent investor has to fight and win.
Which brings us to maybe his most famous idea, the most brilliant metaphor, Mr. Market.
Ah, Mr. Market, your business partner. But he's manic depressive. Every day he shows up, offers to buy your share of the business or sell you his share every single day. But the price he quotes, it's all over the place. Driven purely by his mood swings, wild enthusiasm one day, paralyzing fear the next. Often results in prices that are, well, Graham said, a little short of silly.
And the power of that metaphor is how clearly it shows what your job is. The investor's job. You're the sensible business owner, Mr. Market. He's just this emotional messenger you can totally ignore most of the time.
Absolutely. You refuse to let someone else's mood swings run your financial life. Graham basically said, look, if you did your homework on the business, you should be fine just putting the stock certificate away for 10 years. The daily price, quote, shouldn't matter if the business itself is solid.
Okay, so this forces a big rethink of risk. If a stock you own drops 20% temporarily, which feels awful, is there really risk, in Graham's view?
For the intelligent investor, no. Not if the underlying company is still sound. True risk isn't that temporary price dip. True risk comes from, well, two main things. One, losing actual value because you panic and sell at that low price, realizing the loss. Or two, and this is probably more common, risk comes from paying too much in the first place, paying way more than the thing is actually worth.
Right. And what really jumps out at me here is this counterintuitive idea that falling stock prices, if you're investing for the long haul, are actually good news.
Think about it logically. If you're putting money away regularly, planning to buy more assets over time, price drops literally mean you get to buy more for less money. It's simple arithmetic. Graham used that analogy. Buying stocks should be like buying groceries, not like buying fancy perfume. You want your favorite groceries to go on sale. That habit, relating what you pay to what you get, that's an invaluable trait in investment.
Okay, so if Mr. Market is all about emotion and chaos, we need some kind of structure, an antidote. What's the blueprint Graham gives for the investor who just wants, well, an autopilot? Low stress, defensive, maybe doesn't have tons of time for deep analysis.
Right, that leads us to the defensive investor. This is the person who prioritizes safety and just freedom from constant worry. They want clear, almost mechanical rules.
So what's the cornerstone rule for how this defensive investor should divide up their money? The basic allocation.
The basic rule is all about balance. You divide your funds between two main buckets: high-grade bonds or cash equivalents and high-grade common stocks. And the key guideline is keeping things in a range. Never less than 25% either bonds or stocks, and never more than 75%, which implies, the standard starting point, the default, should probably be 50-50.
50-50. Wow, that feels really conservative today, doesn't it? When you hear advice like 80% or 90% stocks for younger people. But sticking to that balance, it means you always have some dry powder, right? Cash or bonds ready when stocks do get cheap.
Exactly. It's like an automatic governor on your own impulses. It takes the emotion out of the big allocation decision. You just rebalance back towards 50-50 when one side gets too far out of line, stocks get too high, you sell some, stocks get cheap, you use the bond side to buy more.
Okay, let's drill down into that stock part then. If the defensive investor is, say, 50% in stocks, what are the strict rules Graham laid out for picking which stocks? The quantitative rules.
Yeah, there are four main ones, and they really act as a built-in safety measure for the stock selection itself. First, diversification. Pretty standard advice, but he put numbers on it. Minimum of 10 different stocks, maximum about 30. Don't get too concentrated, but don't spread yourself ridiculously thin either.
10 to 30. Got it. Makes sense.
Second, size. Stick with large, prominent companies, leaders in their field, and conservatively financed. He gave a historical number, like $100 million in annual sales for an industrial company back then.
Okay, hang on. That $100 million figure, and the next rule you mentioned about dividends since 1950. Obviously, those exact numbers are dated. For someone listening today, what's the principle behind those old numbers? Is it just about being old, or is it stability?
It's absolutely stability and endurance. Yeah, the dollar amounts themselves would be billions today, adjusted for inflation and growth. The principle is you want companies that have proven they can survive. They've weathered recessions, market crashes, big shifts in their industries, proven leaders, not, the hot new thing.
Okay, so proven stability and endurance. What are the other two rules then?
Third, financial condition. The company needs a strong balance sheet. He specified a current ratio, current assets should be at least twice current liabilities. Gives them a cushion. Plus, a long, uninterrupted record of paying dividends. Shows consistency and profitability.
All right. And the fourth?
Fourth, and this is probably the toughest one, the price limit. The price you pay can't be more than 25 times the company's average earnings over the past 7 years, and no more than 20 times the earnings from the last 12 months.
Whoa. Relying on historical earnings like that, that's a serious constraint. Doesn't that basically guarantee the defensive investor misses out on the next big growth story, the disruptors?
It absolutely does, and that's kind of the point. Graham's insight here is that safe investing, as he defined it for the defensive type, is just fundamentally incompatible with chasing high-growth stocks. He forces a choice: stability and proving value, or potential boom with much higher risk and uncertainty. He found that growth stocks generally were just too uncertain and risky a vehicle for the defensive investor. Why? Because their prices almost always bake in assumptions of future perfection that, rarely happen perfectly.
So this whole philosophy, choosing value, choosing stability, avoiding hype, it all comes back to that central concept, the absolute core of Graham's teaching, the margin of safety.
The margin of safety, yes. It's simply that difference, that favorable gap between the price you actually pay for a security and its indicated or appraised intrinsic value. It's the buffer. It's there specifically for, as he put it, absorbing the effect of miscalculations or worse than average luck. Since you can never know the future perfectly, you need that buffer. It's not optional.
And he found some pretty extreme ways to get that buffer, looking for deep, almost mathematical bargains. I want to talk about one of the most striking examples, buying a stock for less than its net working capital alone. What does that even mean practically?
Okay, let's break that down simply. You're basically looking for a situation where the market values the company so low it's like you're getting parts of the business for free.
Getting parts for free.
You calculate the company's current assets in cash, receivables, inventory, things easily converted to cash. Then you subtract all liabilities, short-term debts, long-term debts, everything owed. What's left is the net working capital. If the total market value of the company's stock is less than that net working capital number, it means you're essentially buying the readily available cash-like assets for, say, 70 cents on the dollar, and you're paying literally nothing for the factories, the equipment, the brand name, the long-term potential. All that comes for free.
That's incredible. And that net-net strategy, as it's called, it worked for decades because the margin of safety was just immense, mathematically huge. It's the ultimate first don't lose approach.
And violating that principle, paying too much, ignoring the margin of safety, the consequences are devastating. Think about that illustration from the sources. If you overpay wildly and your stock drops 50% right off the bat, you are so far behind. Even if that same stock then starts performing really well, say double the market's average return year after year, it will still take you something like 16 years just to get back to even with someone who bought a steady, fairly valued investment from the start. Overpaying doesn't just cost you that initial loss. It costs you nearly 2 decades of compounding. It hammers home why first, don't lose is so critical.
So wrapping this up, what's the core message for you, the listener, trying to be disciplined? It really seems to be. Know what you're doing, define investment versus speculation for yourself. Ignore the daily noise, ignore Mr. Market's moods. Stick to clear rules, especially if you're defensive. And above all, demand that margin of safety.
And maybe the final thought, connecting it all, is something Graham really drove home about where the real risk is. He argued risk isn't primarily out there in the market or even in the specific stocks. The biggest risk is usually in yourself. It's in your emotional strength, your intellectual honesty, your ability to stick with sound policies even when they feel uncomfortable or unpopular. The policies that are, as he said, inherently sound and promising are often precisely the ones that are not popular on Wall Street. Being an intelligent investor, it actually takes courage.